Hi all. Today we are going to discuss another accounting standard, international accounting standard known as IAS 40 investment property, which is also a standard related to tangible non-current asset. In the episode 1, we have covered the IAS 16, that is property, plant and equipment. So this IAS 40 investment property also carries some characteristics of IAS 16. But it is entirely different. The standard entirely differentiate these two assets in two different categories. So I'm going to divide our session into 5 different topics that we will be covering in this session. First one is the meaning. Second is the recognition criteria. Same as that we discussed in IAS 16, that the standard provide 2 recognition criteria that need to be met by the property in order to recognize it as an investment property. And the third one is initial measurement, how we can initially measure the asset into our books of account. And the fourth one is subsequent measurement. As the nature of the asset say, it is a non-current asset. So we are not selling it off the property in that year itself. So we need to understand how subsequently how we can measure the asset into our books of account. So, and then lastly, transfer when change in use. So this asset, the business can change the use of this asset based on their discretion or their usage. In such cases, the measurement or the recognition of asset in the book of account also changes. So that we will see in the last topic. So moving on to the meaning. The standard says investment property is a property that is land or a building or a part of a building or both land and building included, held by the owner or the lessee to earn, see the purpose, to earn rental income or capital appreciation. So the owner or the business management held the property only to earn rental income or capital appreciation. See, and also there is a catch that you need to have it in your mind. This property is not used by the business for their production or supply of in their ordinary course of business. See, in the below you can see, rather than used in the production or supply or sale in the ordinary course of business. So other than this category of property, which are land and building, we are categorizing it as investment property. And also standard provides different method of recognizing this. So we should not categorize this in the IAS 16 category. Okay. I believe you all got the understanding of what is an investment property. You always should focus from the management point of view, because now while you are doing or preparing for the financial reporting paper, you should have the mentality of you are an accountant. So you are preparing the recording the books, preparing the journal entries, posting it, and finally you are preparing the financial statement. Okay. So always have the mentality you are an accountant in an organization. Okay. So the next topic will be the recognition criteria. Same as we seen in the IAS 16, here also we have 2 recognition criteria. First one is, it is probable that the future economic benefit associated with the asset flows into the entity. Okay. For a land and building, we can see that the building will generate rental income. So there is a certainty in the future that the asset will generate economic benefit. That is the rental income. Also, the economic benefit can be the land appreciation value. So this appreciation is also certain because the land is never going to depreciate. It will only going to appreciate. That is also a future economic benefit. And the second recognition criteria is, they are saying is, the cost of the asset can be reliably measured. How how we can determine the cost. So when an organization purchases the piece of land, they have to pay the purchase price. So this purchase price is the cost here. So the cost of the land can be reliably measured here. So there are different land valuers. So from the service of a land valuer, we can be able to reliably measure the land, or we can check the land price of the nearby plot. How much is the value of the nearby plot? Is it same as our plot? So in all that ways, we can reliably measure the value of the land. So standard says whenever we are able to measure the cost of that property very reliably, and also it generate future economic benefit, then we can recognize the asset as an investment property in our books of accounts. This criteria is same as IAS 16, but the thing we need to have it in our mind is the purpose of the property. So when an organization purchase a land and building, and they use the building and the land for their administrative purpose, for example, they have used the building for their administrative purpose. All the employees office work, the paperwork, all are handled in a building. Then that building is accounted under IAS 16 rather than the IAS 40, because in the IAS 40 it says it should be only for the purpose of earning rental income or capital appreciation. When an organization use it for their administrative purpose, would they able to generate rental income? No, because their employee itself using the space, the building space. So this condition is not met. So in such case, it should be accounted under IAS 16. In all the other cases, it should be under IAS 40. I believe you got the understanding about about the meaning and the recognition criteria, right? Then after the investment qualifies for the recognition criteria that we seen in the above, it will be initially measured at cost. So what is the cost? Cost will be the purchase price, the price that we paid to the vendor or the supplier or the initial landowner, plus if there is any additional directly attributable expenditures such as professional fee for legal service, property transfer tax, and other transaction costs. So now you need to see is the liberty that is provided by the standard to the management. Because once an organization purchases a building or a land, they are not only incurring the purchase cost of the land itself, they are also incurring other expenses such as the legal fees, the stamp fees, the professionals that help us to transfer the ownership of the land to our management name. Okay, and all the other transaction costs. So all this directly incurred expenditure can also be added up to the value of our land or building, the purchase price of the land. Okay, so whenever I will give you an example. See, the organization purchased a piece of land that cost them $1 million, and they cost a professional fee for the legal service of 10,000, and also they have paid some taxes of 20,000. So how they measure the value in the books of account? They make the cash payment for all this expense as well as the land cost. So they can pass the entry by debit the land value as 1 million plus the 10,000 legal fee plus plus the 20,000 tax expense. That will be 1,30,000 will be the price or the initially measured value in the books of account. And they will credit when the cash goes out, it will be credited to cash. You get the point? Okay. I believe you all got the idea about what is the meaning. It can be a property that can be in land or building, solely for the purpose of earning rental income or capital appreciation. We should focus. It should not be in the terms of production or supply or sale in the ordinary course of business. Then we see in the recognition criteria, the property should generate future economic benefit associated with the asset which flows into the entity. Then the cost of that asset can be measured very reliably. So in case of land, we can use the land valuer, the real estate valuer. They provide the professional service for us to get the value of the land. Okay, and then we see in the initial measurement. Initial measurement will be the purchase price plus any directly attributable expense such as professional fee, legal fee, and property transfer fee and other transaction cost. So all this cost can also be added up to the value of the original price of the land or a property. Okay, then we will move to the subsequent measurement. So what is a subsequent measurement? As I initially said, subsequent measurement says or give the guidance to us on how we can subsequently measure the or record the property value in our books of accounts. Because it's a non-current asset, and also in most cases we are not going to sell off this asset in the same year that we purchase assets. So as an accountant, you should be able to understand how the investment property can be measured, subsequently measured in the books of account. Okay, so the standard offers choice of two models. Same as we seen in the IAS 16, we have two models here. First one is the cost model and the second one is the fair value model. See, the cost model is same as we discussed in IAS 16, that we should carry the value of the asset as at cost initially, then less, then then over the period of its useful asset, we need to deduct the depreciation and if there is any accumulated impairment loss. See that we have seen the depreciation method of a straight line method. We will value the property at its initial cost, and if it has a useful life of 10 years, then over this 10 years we will depreciate the value of the asset to when it becomes the zero or until it becomes the scrap value. And also we need to check if there is any impairment losses happen, such as accident or if there is any natural calamities that causes the value to depreciate. That impairment loss also we need to consider in the books of accounts. I believe you all got the picture about how we can measure or subsequently measure the asset under cost model. Now we can move to the fair value model. This is completely new in terms of what we have discussed in IAS 16. In there, we have a model known as revaluation model. Here we will use the fair value model. Okay. So the standard says investment property is measured at fair value at the end of reporting period. See, you need to see this is the subsequent measurement. Initially, we will measure at purchase cost and any directly attributed cost. And then at the year end, at the reporting date, we need to remeasure at the fair value. What is the fair value? Fair value is the market value. So you will see, so for the standard also, the IFRS standard also provide a single standard known as IAS 13 for fair value valuation. So for now, you need to think it is a market value. This IFRS 13 will be covered in our SPR syllabus. So now you don't have to be worried how we can determine the value of fair value. Just in the question itself, it will be given the fair value. Okay, so only thing that you need to keep in mind, this fair value is the market value. And the standard here, the standard says the property should be initially valued at the cost and later at each year end, the property should be measured at fair value. So you know that the fair value is the market value. If it is a land, then the land value should increase or decrease, right? So if there is any fair value increase or decrease or loss or gain is accounted in the profit or loss statement. So if you have seen in the first episode of IAS 16, there, if there is any revaluation increase or decrease, where do we account it for the revaluation increase? We will take it to other comprehensive income. But here the picture is completely different. We will take it to P&L account. Because why we will take the fair value increase in the IAS 40 to P&L? Why can't we show it in the OCI? Because here the land value is certain. The value of the increase is very certain. When the management determine the value increases, that is the real increase. Whenever they sold that property, they will get in the same day, if they sold the property, they get the same amount. So it is a real profit or the gain that the organization will generate if they sold the property. So this gain or loss had to be taken to P&L rather than to the OCI for investment property. Okay. And also, one more main thing that we need to notice under IAS 40 investment property, under fair value model, the property is not depreciated. In cost model, it is depreciated. See the difference. Very important. You might, mix up together. Please note, under cost model, we need to depreciate as well as we need to consider the impairment loss. But here, see, we are not depreciating the asset. And in most of the 99% of the case, the investment property will be valued under fair value model. Okay. And whenever the management uses a specific model, they should apply all the investment properties under the same model. If the management uses fair value model, then they should use the fair value model to all the investment properties they are handling. Okay, why I'm saying this very cautiously, why I'm saying this will be tested in our FR exam. See, these all points are theoretical, but it will be tested in our FR syllabus in FR exam. So you should have the complete picture on what or how the models are differentiate between each other and how the management fixes the model. And when they fix a model, that model has to be applied to all the investment properties. Moving on, let's see one question. See, let us move to an Excel sheet so that we can do the the solution together. Let's read the question first. On 1st October 20X9, Propex has the following property. It used the fair value model to measure the investment property. See, on 1st October 20X9, they have the following properties, 1 and 2. This will be the following properties. And they use the fair value model, not the cost model. Keep it in mind. For the investment property. And the scenario is first scenario. The tenant house will cost 150,000 on 1st October 20X4 in the past. They are saying at the past value. And the property is a freehold and is rented to private individual for 6 monthly period. And the current market value of the property is 175,000. See, that is the first scenario. And the second scenario is Stovey Place, which costs 75,000. This is used by Propex as its headquarters. The building was acquired on 1st October 20 W9. See, W9 will be the past decade, that is 10 years back, decade. The current market value is 120,000. It also appreciated. In both the cases, the value of the property appreciated. And Propex depreciate its building at 2% per annum on cost. Okay, they use the depreciation of 2%. What is the requirement? How should the property be shown in the statement of financial position at 1st October 20x9? So 20x9, 1st October 20x9 will be the year-end date. So we need to give them the answer on how we can value the asset in the balance sheet. That is the financial position. Okay. So let's move to the first solution. Let's take first solution. It says initially on 1st October 20x4, the value of the asset is 150,000. And then what happened? At the year end, currently the market price is 175,000. That is 1st October 20x9 will be 175,000. See? So in the pull down list, we have the answer. See, we don't have to depreciate it. As per fair value model, we don't have to depreciate it. And also see, it satisfies the purpose also. They are using it for renting to private individual. They are not using it by themselves and generating rental income. That's why we can recognize the value of the asset at the year end or at 175,000. Can you give me the journal entry posting? When there is a capital appreciation, what should we do? We should take it to P&L. So the entry will be, the gain will be debit investment property by 25,000 and then credit gain to where? To P&L by 25,000. Please don't mix it up with IAS 16. IAS 16, we will take the gain to OCI. Okay. So let's move to the, I believe you have cleared on the first scenario. We can move to the second one. Second one, let us read the question again. Stovey Place, which costs 75,000, is used by Propex as its headquarters. The building was acquired on 1st October 20 W9. The current market value is 120,000. So what will we do? The same, right? Same, it will be like we considered 175,000. The at 1st October 2019, it will be 120,000. Right? You agree with me? No. The answer is not right. Why? See the purpose. See the purpose of the asset. The management use as it headquartered. Why? For their administrative purpose. When they used for the administrative purpose, can we take it as an investment property? Did it met our condition? No. Why? The condition is for rental income only for rental income and capital appreciation, not for ordinary course of business. Here they are using for their business purpose, for headquarter, for their employees to work there. So in such case, what will we do? It will be accounted under IAS 16 property, plant and equipment. So what we should do? We should depreciate to depreciate at 2%, 2% each year. So how will be the current market price or the current carrying value? See, so the depreciation will be. So we should not consider the fair value increase, okay? Because it is under cost model. We are not considering the fair value increase or the revaluation. Here it will be under cost model because that is a default model that we need to consider when we are doing the question practice. Okay, so here it will be 75,000 equal to 75 into 2% will be the annual depreciation. And how many years they have passed till this year, till current year? From 20W9 to 1st October 20X9, it is 10 years. So equal to 10 years into annual. It will be 1,000. 15,000 will be the accumulated depreciation. And what will be the carrying value? Carrying value will be equal to 75,000 minus the accumulated depreciation. It will be 60,000. See, our answer 60,000. Now I believe you got the picture about the two scenarios. So focus, don't ever mix up with the IAS 16 with IAS 40. You should always be cautious on answering the question in the exam. Okay. Moving on to our topic, we have done a question, and the next topic you are going to do is transfer when change in use. So, as an introduction to the transfer, let me say, this investment property can be, the purpose of that investment property can be changed at any time based on the management's purpose or the discretion. The standard says the investment property can be changed to property, plant and equipment under IAS 16 or to inventory under IAS 2. Okay, which they can classify it as inventory and they can sold it as based on their ordinary course of business. So what the standard says here is whenever there is a change in the status of the property or the change in the use, we also need to change the accounting treatment. See the example below. When the land and building held for rental and capital appreciation has been used by the business for administrative purpose or the production purpose, that is owner occupied. Where, see, this is the transfer. The land that has been held by the organization for the rental or capital appreciation has been changed to administrative or production purpose. So what we do, what we have to do? We need to change from IAS 40 to IAS 16. Right? Consider the situation below. See here, we have two situations with the year end of 31st December. And the change of the use happened at 1st July. I will give you the scenario when an organization purchased the land for doing a business. And once they purchased the land, they came to know that it will take minimum 5 years to start the business or do the construction in that land. It will take 5 years from now. So what the organization can do for 5 years? So the 5 years, this asset is under with them. They are not doing any commercial activity. So till this 5 year, they will recognize this as investment property. And after the 5th year, what happened? They can use it for their business purpose, like for building a production facility or for their administration purpose. They can use it as their headquarters, like the example that we seen above. So after 5th year, uh, we need to change the accounting treatment of the asset to IAS 16. That is what the scenario explained below. See, a change in use from investment property to PPE. And this is the accounting treatment they are saying. So, and the change in use happened on 1st July. That is mid of the year. So, till 1st July, assets should be accounted under IAS 14. That is, there is no depreciation or fair value gain or loss to be P&L. And after 1st July, the asset should be accounted under IAS 16. Where, please note, where the initial measurement at fair value at the transfer and then commence the depreciation and impairment loss. See, the main twist happened after 1st July. When the transfer happened at the 1st July, the management should book the initial cost at the fair value of of the transfer. When the transfer happened, whatever the price of the asset at IAS 40 need to be taken to IAS 16 as its initial cost, initial measurement. That fair value at the transfer should be taken as the initial measurement, and subsequently, as we seen in the IAS 16, they can depreciate and also they can check for the impairment loss. So this depreciation method and all should be on a pro rata basis. So till 1st July, they haven't expensed any depreciation, and after July, they have to consider the depreciation. Okay. Same, this is second scenario is when there is a change in use from PPE to investment property. See, the example I said before, the 5-year case. So let's interchange the situation. See, they have used the land for their administrative purpose for 5 years, and after 5 years, they don't have any administrative purpose to do. So there is nothing happening in that land or a property. They will change because the purpose change. They will change it to IAS 40. The accounting treatment will change after the 5th year. So what will be the entry? Till 1st July, assets should be accounted under IAS 16. And after 1st July, assets should be accounted under IAS 40. And also, the same twist happened in the above. Here also it will happen. At the date of change, property revalued to fair value. And that fair value, gain or loss should be treated as a revaluation under IAS 16. Why? We have to consider the fair value gain or loss under IAS 16 revaluation model. Because till that date, it was considered as an IAS 16 asset. So whatever gain or loss happened at the date of change should be considered under IAS 16. So if there is a fair value gain, where have to be book that gain under OCI. Remember our IAS 16 standard. If you are not getting the picture, just go to that our first episode for the IAS 16 and see how the revaluation model works. Okay. I believe you all got the idea when there is a change in the use of investment property to PPE or vice versa from PPE to investment property. Very, very, very Very important to see this, to see two different situations. To clarify more, let's do one example on the transfer. For that, we can move to our Excel sheet. Question 2. See, let's read the question first. Capital owns a business which it has been using as a head office. In order to see head office, it's their administrative use. It is under IAS 16. And in order to reduce the cost, on 30th June 20X9, it moved its head office function to one of its production center. What happened? They moved their head office function to another center, and they now letting the building. Now they are letting out their building. Letting out means they are renting it out, so they can generate rental income. And the company policy is to use the fair value model for investment property. They use the fair value model, not the cost model. See, under investment property, IAS 40, we have two model, cost model and fair value model. So management policy, they use the fair value for the investment property. Don't mix it up, okay? And the building had an original cost on 1st January 20X0 of 250,000. And was depreciated over 50 years. At 31st December 20X9, the fair value was judged to be 350,000. But the point, their initial cost of the asset is 250,000, and it was purchased on 20X0 and depreciated over 50 years. At 31st December 20X9, it is valued. Its fair value was judged to be 350,000. Okay. So the requirement is explain how the building will be accounted in the financial statement of capital company at 31st December 20X9. So December will be the year-end date. Okay, let's see. So we can divide the property accounting treatment under IAS 16 and under IAS 14. So under IAS 16, initial value is 250,000. So till June 20X9, we need to depreciate the asset. That will how much will be the period? That will be 9.5 years. Right? Am I right? Yes. So the depreciation will be so first we can calculate the annual depreciation, then we can calculate the accumulated depreciation. So the annual depreciation will be 250,000 divided by how much is the useful life? 50 years. It will give us the annual depreciation. What will be the accumulated depreciation? It will be 5,000 into 9.5 years. It gives us 47,500 will be the accumulated depreciation till June 20X9. After June 20X9, what happened? There is a transfer in the change of use to IAS 40. So let's also determine the carrying value under IAS 16. How much will be the carrying value? The initial value minus the accumulated depreciation. So 202,500 will be the carrying value at 30th June 2020 X9. Good. You got the picture? How we determine the carrying value under IAS 16? And then what happened? Then after June, we valued it as IAS 40 because they rent it out to generate rental income. See the letting out, it's head office. So what happened? And then at the end, it will be 350,000. So what we have to do? The carrying value is 202,000. And then what happened? The fair value is 350,000. What happened to the revaluation? There is a revaluation, fair value increase, right? So what is the fair value increase? How much will be the increase? It will be 350,000 minus 202. See, 147,500 will be the fair value increase. So how we can account the journal entry? Journal entry will be, we have to debit the property on us at 350,000. Because it should be carried, because under IAS 40, we should carry the value at each reporting date at fair value. The fair value is 350,000. And how will be the split gonna be? We will be crediting the gain at 147, and the property value is and the carrying value will be 202. You got the point? Now it gives, see, the total amount 350,000. I believe you got the picture how the property should be valued. It will be 350, and the gain will be gain. Where will we take the gain? Under IAS 40, gain to P and L. Okay. Any doubt? Any doubt with the question? At 30th June, it will be 202, and then happen the change in the use. So transfer happen. So we'll be taking the carrying value will be this much. The fair value is this much. So fair value increase will be taken to P and L, and then the carrying value is 350,000. After the transfer happen, please note there is no depreciation for IAS 40. But here we will have the depreciation that is on the pro rata basis. That's why till the change in use, that is till the mid of the year, we have took the depreciation. That is why we took 9.5 years. I believe you all got the picture, right? Okay. Moving back to our note, we are coming to the end. The last topic is the disposal. So once the property is disposed, even in the case of IAS 16 property or IAS 40 property, the gain or loss from the sale of the asset should be taken to P&L. Got it? The disposal gain, or if it is a loss, should be taken to P&L statement. There is no OC or nothing. Same as IAS 16, we have taken the disposal in IAS 16 also to P&L. So we come to the end of this session. Any doubts? Here we have covered the meaning. Let's conclude it up. The meaning is it's a property that can be land or building or part of the building or both of land and building included. It is owned by the owner or the lessee under lease contract to earn rental income or capital appreciation. So we need to check the purpose. It should not be held for production or supply. If it is held for production or supply, it is under IAS 16. And then we have the recognition criteria. Under recognition criteria, it is probable that the asset should generate future economic benefit. Also, the cost of the asset can be measured very reliably. Okay. And then we have the initial measurement. How we can initially measure? We can initially measure at cost, and also the standard give us very good liberation on the related cost or the directly attributed cost incurred. What the standard say? We can add up this directly attributed expenditure to the value of the for the purchase price of the asset. And then we have seen the subsequent measurement. The standard give us two models. One is the cost model and the other is the fair value model. Cost model we have seen same in the IAS 16. We need to carry initially at cost, and then we have to depreciate over its useful life. And if there is any impairment loss, that also need to be considered. Okay, then came the second model, that is the fair value model. Under fair value model, the investment property need to be measured at fair value at each reporting period. And if there is any fair value gain, fair value gain or loss, both the cases we need to take it to P&L. And also there is no depreciation under fair value model. So two things to be noted: any gain or loss to be taken to P&L, and also there is no property to be depreciated. Also, please note, whichever model we choose, we need to apply that model to all the investment property held by the business. Okay. Then we came to the last topic, that is the transfer of the accounting treatment when there is a change in use. That is from IAS 16 to IAS 40 or IAS 40 to 16. And we have seen two different scenarios of the change in use. That is, whenever there is a change in the investment property to PPE, let's assume it happened at the mid of the year, that in the mid of the year, it has to be initially measured at the same fair value of the asset valued at IAS 40. That same fair value has to be taken as the initial cost in IAS 16. And then we will commence the depreciation and impairment loss. And in case of PPE to investment property, at the mid of the year, we need to, and if there is any revaluation, so mid of the year, data has to be taken, so initially measured at fair value, and there is any fair value increase or decrease happen, we have to take that gain or loss to under revaluation model in the IAS 16. At last, we have seen the disposal gain or loss has to be taken to P&L account. So we come to the end of this session. I hope all has got the idea about how we can account the IAS 40. Have a nice day.